everyone, and welcome to one of our knowledge transfer sessions. Today we're going to be talking about the complicated topic of annuities. Actually, I even put a little teaser on here. You don't know what you're talking about when we're talking about annuities, because one of the jokes I've always talked to with annuity reps is that whenever they come in my office, they have so many products or so many different ideas, so many different types of contracts, that even they don't know what the word annuity means. And so I would argue that the general public doesn't know what the word annuity means. And it is a complicated topic. There's lots of sales pitches that can go with it. But I thought a good overview, a well-rounded history and understanding would be really useful today. So as always, I always want to mention today's information has to be treated as general in nature. I'm going to be summarizing a lot of annuity contract language. And when you do that, there's going to probably be something that's lost in translation that is not applicable to a specific person. And so I just wanted to mention that today's information has to be treated as general in nature. A little about myself. I have more than 18 years experience in the financial services industry. I run a independent financial advisor practice in Bellevue, Washington State. In fact, most of my presentations are going to be Washington State focused because that's where my background and history is from. In today's context, though, I did want to mention I spent over 5 years working inside an insurance company, a life insurance company specifically. So I would argue I have a really good, broad-based understanding of dealing mutual funds, where I started my career selling, working for an insurance company, working for a bank, and being an independent financial advisor who can do a broad variety of things. So I'm hoping today to give a pretty balanced explanation of annuities and not just have this be either an annuity sales pitch or a presentation hating on annuities specifically. So what we're going to talk about today, we're going to talk a little history about annuities, because if you look at the history, you're going to see that the history kind of tells you how these work. Then we're going to talk about the basic problems with annuities. We're going to talk about reasons you may want to consider it, and then reasons not to consider an annuity. But let's start with the history, because the history I find interesting. Now, I'm kind of a history nerd, and I also like talking about financial products. But the word annuity comes from Roman word annua. And the Romans were the first ones to really come up with life expectancy tables. So the idea of life insurance and life expectancy, we got to give credit to the Romans, basically. Modern annuities really start to come into play with tontines, which were created in France, where you could take a lump sum of money and purchase a lifetime income stream. In the United States, the first annuities really were started around the 1700s. But really, when we look at the 19th century, or in most of the United States history, life insurance was more popular than annuities as a primary product that life insurance companies would sell. In fact, if you look at it, until 1920, about only 1.5% of life insurance premiums were in annuities, actually. What happened, though, is a major shift did happen. The Great Depression happened. And when the Great Depression happened, we didn't have FDIC insurance for banks then, and banks started to fail, and insurance companies didn't fail at the same rate. And so if you were trying to deposit your hard-earned money, over time, you started to shift towards insurance companies because they were safer potentially at that time. Whereas, banks today are FDIC insured. At that time, they weren't. And so you'll see in the 1930s, they grew in popularity, and they were starting to be used as retirement investment vehicles. Now, variable annuities was the product that was supposed to be the kind of the rock star of the annuity industry. And it's still popular today, but it was supposed to be the rock star because annuities are almost always fundamentally fixed contracts. Not necessarily, but almost always they have a fixed component as part of their construction. And the problem with most fixed asset classes is they tend to lose to inflation as a general rule of thumb. Well, TIAA-CREF figured out, what if we took a basket of stocks called a sub-account? They look similar to those mutual funds over there that people don't like. And we'll put it inside these annuities, and you can invest in these sub-accounts to kind of grow your money and beat inflation. And if you look at from 1977 to 1993, these style of products grew in popularity. And if you look at articles back in 1993, you'd see that variable annuities were poised to kind of be the rock star. But then something happened. In 1978, we really went to the 401k system in the United States. And ERISA, the law ERISA, had a pretty important component where the Department of Labor was doing audits of the plan sponsors, the people who were sponsoring the 401ks, and it was starting to hold everyone from the advisor to the companies to the fiduciary standard. And at the same time, you had things like Vanguard's revolution around mutual fund fees. And what happened was that all these companies and advisors were being held to fiduciary standard. At the exact same time, mutual funds were getting really cheap. And we can see by 1990 through 2000, mutual funds had gone from a 9% market share to a 48% market share of overall U.S. deposits into retirement vehicles. And they started to become the dominant form of retirement vehicle at that time. Okay, and so what happened was we were going to have variable annuities be like the hot product, and then mutual funds just knocked it out, basically, because they function oftentimes very similarly. But from history, we get three basic concepts for annuities. Income, a deposit-based product that's designed to, say, give you 5% for 5 years, and at the end of 5 years, you get your money back. It looks like any sort of structured product. And then variable or market-based annuities. So three basic ideas here. But still, if I use the word annuity, it could be either one of these three. We still haven't gotten really specific yet. And that's the basic problem. The word on its own is meaningless because the word annuity is representing an insurance contract, and how that contract is written can be fundamentally different across the entire spectrum. In fact, what I did here is I went to one company, and I went to one section of their annuities. So this company has a lot of annuities. And I just copied down all the marketing terms or all the marketing sentence that went right after the product name. And in this one company, I have 8 fundamentally different products that have different contracts, that have slightly different features, that I would have to analyze in one single company to understand the word annuity. And this is one company, and I didn't even use all the products that are available within this one company. And so one of the first problems you have to understand when you talk about the word annuity is annuities are fundamentally a contract, and just like any other type of contract, it could be very different from one contract to the next. And if you try and research this yourself online, if you try and go watch videos like this one, there's actually a basic challenge. I would argue the generic explanation you're given doesn't actually reflect the reality of annuity purchases or sales. Okay, what you generically research is only accurate to a very specific annuity that they don't even describe in what they're telling you. And so I took an explanation of what annuity could be from the Washington State Office of the Insurance Commissioner. I took one from a Guide to Annuities, which is a website. I took one from Dave's Ramsey. I tried to pull like all sorts of sources, just basic explanations of what they think annuities are. And if you look at here, almost all these explanations are talking about income. Some kind of mention there's diversity here, but they're all talking about this concept of income. So you might think, if you're researching this yourself, that annuities are designed to pay income. But maybe not. So LIMRA is the number one researcher of insurance products. It's an organization that a lot of insurance companies feed data to so that there's a good broad-based research for the insurance industry. And they would point out that the majority of annuities that are purchased are based upon protection from investment risk and not longevity risk. So when we're talking about income, it's typically you're talking about longevity risk. When we're talking about protection from investment risk, you're usually talking about a structured deferred product. And here's what I mean by that. So if this is once again from LIMRA, this was total sales, retail sales of annuities in 2024 based upon the data they had available. Okay. And you're going to notice that the income annuity, the one that's clearly designed income, is only roughly 2% of overall annuity sales. That means the majority of annuity sales are typically done to protect against market risk and not to provide lifetime income. Now, income riders are going to be the wild card when you look through this. A lot of annuity contracts are sold with something called an income rider, which fundamentally changes how the annuity works. But if you even go down this list, fixed rate deferred, fixed indexed, registered index linked, and then traditional variable, you're going to see that probably the majority of sales of all these annuities was not for the purpose of income, just like LIMRA is saying. So the generic thing you read about, talking about income, may not be actually what the vast majority of sales are about. So then we got to talk about types of annuities. Let's keep drilling down from that idea of income, protection from market risk, and variable to more specific types, more specific terms. And so we have to start talking about the idea of immediate versus deferred. Immediate is where you give an insurance company a lump sum of money and they start a payment stream for you, typically for the rest of your life, but there can be other terms, because remember, it's a contract. There could be other terms you decide to agree to. And deferred annuity is where you are buying it and you're going to buy it, say, for a period of years, like 5 years. And at the end of that, you could take your money and run, or you can turn it into the immediate, okay? And most people are going to do the first option, which is take their money and run or move it to another annuity via 1035 exchange, though you could keep it in there. And so when you go down the different types of deferred annuities, you're going to find there's things like fixed annuities, index-linked annuities, variable annuities, registered index-linked annuities, and then income riders. And I just want to make a note about income riders. Income riders are like a 2-page document you attach to an 80-page insurance contract. And the 2-page document usually says something like, this will supersede all other 80 pages, which means that 2-page document's really what you're buying out of the 80 pages. So income riders are your wild card. They can, or riders in general, frankly, with annuities are the wild card. They can severely change the contract just with 2 pages, okay? But you have all these different types of contracts, different types of styles, different types of goals, different types of ideas you might want this for. And so when we're talking about the word annuity, it's actually probably more precise to start falling into these different styles. Now, another basic problem, especially if you're trying to research annuity or understand what the word means, is the concept of fees. Annuities definitely have fees, but trying to figure out what fees apply in what situation can actually be hard. And once again, when you go to research this generically, you're going to find that they're oftentimes describing a specific type of annuity from that previous screen and excluding the others in their definition, because it's really hard to try and explain across all the product types, across all the different types of contracts, across everything in a simple sentence, how an annuity works. And so when we talk about what fees apply, depending upon the type of contract you're going to buy, you're going to find there's typical fees that are going to apply over others. I got this from a website that's trying to sell annuities. This is not a all-inclusive. This is a general way that fees work, right? So if you're talking about surrender charges, the vast majority of annuities have surrender charges, but not all. Even RILA's down there has a check mark. I know RILA products that don't have surrender charges. Administrative fees. Some annuities have them, some don't. Mortality and expense charges. Rider fees, right? If you're adding riders to the annuity. Or expense ratios, right? These are all the typical fees you can run into with annuities. And they're going to apply based upon what you're buying. Another problem when talking about annuities is what are we supposed to compare these to, right? So this is if you look at the historical concept of this is a retirement option designed to, the Great Depression made this a retirement option designed to be a deposit product, right? But today we have mutual funds, we have ETFs, we have individual stocks, you have alternative investments, right? Trying to figure out where an annuity is supposed to fit in someone's financial plan, if it's even applicable, can be hard. And so typically when you see annuities are compared to asset classes, you're going to see it compared to other types of fixed asset classes, because fixed asset classes probably are the most analogous competitor of an annuity. Something like an S&P 500 fund. You could compare an annuity to an S&P 500 fund, but generally you would say that that's a growth-oriented vehicle, whereas an annuity is trying to provide some level of guarantees, and there's going to be some trade-offs there, basically. Whereas a corporate bond fund is typically designed to provide volatility control to your portfolio, which is more precisely what an annuity is trying to do as well. So that's kind of the problem when we talk about the word annuity, right? If I, even right here I have on the sentence, if I say the word annuity, I would argue you don't have any idea what I mean, even still. And it can be really easy to be negative on annuities. And if you want a personal opinion, I think the sales pitches around annuities are wildly unfair. But it's not necessarily fair to say annuities are bad either, because there are lots of good fits for annuities. And so it's kind of a good idea to go through the different concepts of why you might want to consider an annuity. And the basic reason you might want to consider annuities is concept of to guarantee or to not guarantee. In the financial services world, the word guarantee is like a very sacred word. Right now, I'm sure my compliance office, who has to watch all these videos to make sure I don't say anything totally wrong, is probably leaning forward a little bit going, what are you about to say here, John? Because the word guaranteed is a very sacred word. And insurance companies can make contractual guarantees, which means you have to find what that guarantee is, right? Lies by omission can be a major problem in the insurance industry, in fact. But insurance companies can make what are called contractual guarantees based upon their claims paying ability with the appropriate disclosures, basically. And so when you're talking about do you want an annuity or not, one of the basic concepts you want is, do you want a guarantee or not of some type? And when you're talking about that, we have to kind of go through each of the products and go, well, these are the typical guarantees you're looking for within here, okay? Or basic concepts you might want to consider. So like a fixed annuity. Most of the time, the term you're going to look for is multi-year guaranteed annuity, meaning that you buy an annuity for a certain period of years, and the interest rate is exactly that during the period of years. It's like having a fixed mortgage, right? You know your interest rate is the same year by year. That's the goal. And so you could buy like a 5-year product, and it might pay you 5% a year, guaranteed by the insurance company contract. And you want this feature called a 10% withdrawal because then you can make it part of your income plan. If the market's going down, you can supplement the rest of your plan by taking up to the 10%. And you can use this as a hedge against market risk, and it would compete against, say, bond funds in your portfolio. Now, an index-linked annuity is an attempt to get better rates of return than a fixed annuity. And there are times that it will have better rates of return. And the way that works is you're going to tie your interest to some type of index, right? And usually we're talking the S&P 500, but these products have gotten more sophisticated. So it could be lots of different indexes. And the way it works is it looks at the day the index, well, depending upon the calculation. Once again, lots of calculation methods too. But an annual point-to-point, the way it works is, let's say you buy this June 1st. Well, it's going to look at June 1st this year. It's going to look at May 31st next year, right? A full calendar year. And whatever the market did during that period, if it goes down, you don't lose any interest. If it goes up, you can make up to the cap rate. So if it goes up 10%, you make 8.5%. If it goes up 6, you make 6. If it goes negative 10, you make negative 10. Okay. And the idea here is you can earn anywhere from 0%, which is on most illustrations, they're going to show you the 0% number, up to, say, 6.19%, depending upon market conditions and your individual point-to-point. Now, registered index-linked annuities, a more modern style. That's probably the newer of these groups here. And this works a little differently than almost all other annuities right now. What this works, it works more like a structured note, if you're familiar with how that works. You buy an annuity, and within there you invest in a period of 1 year, 3 year, 5 year, 6 year. There's going to be investment periods within this bucket. And within that investment period, it's going to look at the S&P 500 during your point-to-point calculation, and it's going to protect you from the first 20% of losses. That's a buffer. Market goes down 23, you only go down 20. Market goes down 30, you go down 10. So it gives you the first, for that period, it gives you that buffer. And then it lets you make up to the interest rate based on market returns, the index's returns specifically, for that annuity. So like, on 1 year, it might be, you can make up to 12.75%. If you buy a 3 year, which means you're going to lock up your money for 3 years, you might have no cap. You might make literally market rate. There could be secondary fees like advisor fees in here, so that would be one thing to be aware of. But that's another way to hedge against market risk. Immediate annuities, the old style, the tontine, pure actuarial math. You give an insurance company a lump sum of money, they give you an income stream for the rest of your life. Okay, and if you look at the withdrawal rates versus say the 4 or 5% rule, if you want this for income, it's actually pretty significantly higher income. It does a really good job of providing income. But there are clearly other problems potentially with this. What happens if you die early? What happens for your heirs? Things of that nature. You're going to lock up your money in this contract basically forever. So there's trade-offs here. But if we're talking about trying to cover income and longevity risk, very simple, easy to understand product. A fixed index annuity with an income rider, or variable annuity with an income rider, or fixed annuity with an income rider. Income riders just modify the base contract. So what this is going to do, if you looked at the previous screen talking about the indexed annuity, this is going to lower the cap rate. It's also going to add fees for the writer. So you should automatically expect all those articles you're talking about saying you pay big fees and your money's barely growing. That's accurate. But there's also an internal insurance company calculation saying you could put your money in, say, age 60, and age 70 get significant money out for the rest of your life. In this example, $30,000 a year. And at age 70, you can say combine this with Social Security, which has a COLA. This won't have a COLA. And on a guaranteed basis, the second individual wakes up, have about 70 grand a year of income for the rest of your life. And then from 60 to 70, some point there you're going to retire, and you just got to bridge that gap until this all kicks in, basically. And this is an example of using an income rider as part of a financial plan. Now, here's an interesting thing about annuities, and I've modeled this a lot, and I always expect I'm going to get higher estate values, depending on how you model things, not using an annuity versus using an annuity. And I've always been diving into why do annuities sometimes just mathematically win? There's potentially fees, there's trade-offs, something was off there. And I started to really dive into the 60-40 stock bond split. It's something I use in my practice all the time. Like if someone came to me and said, I want to use this fund for retirement, and it fit their risk profile, I would look at it as a suitable investment, and we'd go through the positives and the negatives, and if that's what they want, I would have no problem with it, actually. But when you deconstruct this fund, which you can buy yourself, right? You don't have an advisor or anything yourself. You're going to see it's weighted like this. About 30% is U.S. equities, and about the rest, 70%, is non-U.S. equities, half of which are bonds. And if you really dig down even further to the bond portion, about 25% is this Fidelity Series investment grade bond fund, with an average total returns for 10 years of 2.41%. Okay? So if you look at this and you look at even yourself and you see that 25% of your money is in something you earn 2.41%, you could probably go get a high yield savings account. You could probably get a CD. There's lots of articles talking about how cash started to beat bonds. You could look at other investment vehicles, non-correlating assets, whatever, and beat that number. But the interesting thing too is annuities, when you compare to that number, start to perform really well, actually. Mathematically, you earn something earning 5% for 5 years on a guaranteed basis for something that over the last 10 years earned 2.41, could be higher in the future, but over the last 10 years earned 2.41, you'd probably mathematically agree the annuity's better. Now, that doesn't mean annuities are perfect, right? So we have to go, okay, why consider it? Why not consider it? In my practice, I always say nothing's perfect. There's the right financial plan for someone, the right retirement plan, but not always the right products or solutions. And so, kind of that previous example, annuities might win mathematically against a lot of modern constructed portfolios, but so could you. I already talked about how you could potentially beat this yourself just buying a CD, right? So it doesn't mean you have to necessarily need an annuity, and you might be more comfortable trying to beat this yourself. But also remember, the annuities usually core two goals are to provide income or to provide protection from market risk. And, if you already have a pension that you can maximize, which is usually a better idea than buying an annuity, by the way, if you have rental properties, if you have really good Social Security, if you have things like dividend stocks, you might have your income plan already taken care of in another solution. Probably don't need an annuity for income. If you have already figured out how to protect yourself from market risk, you have CDs, you have high yield money market funds right now, structured notes, all sorts of low correlating assets. There are ways you can protect yourself from market risk yourself without using an annuity that would compete just fine here. And also when we talk about buying an annuity, there's also the emotions of doing that, right? You have to interact with an insurance agent who has licenses, who might sell you on something. That can be awkward, especially when we're talking about your life savings. It's not, I'm buying a car right now, and going to the dealership can be an awkward experience, and that's just me buying a car, not talking about my life savings. You might prefer to do your retirement planning yourself. It might just make you more comfortable. Right? There are certain people I look at their situation, like you should do it yourself because the stress you will have not doing it yourself will be too great. Sometimes you just don't want to give up control of your money. Almost inherently, giving your money to an insurance company is giving up some level of control in exchange for something. It just may not be the right retirement style for you. An example is the split concept retirement style, where you take half your money and you spend it, and you take half your money and you grow it, and you know that half is going to go to zero, and you're hoping the second half grows. Mathematically, and based on history, it should if you've done it right, but that just might not be the right emotional retirement plan for you. So just to close this out, when we talk about the word annuity here, instead of saying the word annuity, say things like multi-year guaranteed annuity. Say things like index annuity, immediate annuity, an income rider or rider you bought. There could be annuities with long-term care riders as an example. Variable annuity, and then remember, a lot of variable annuities will have riders. Registered index link annuity or RILA. If you're at a party with financial professionals, you want to throw a word out there, say the word RILA, and you'll get a good nod. That's maybe a little too nerdy of me. But basically, just think about these are the terms that really matter. The word annuity is honestly meaningless. So we're here to help. If you ever have questions about this or any other topic, we're always happy to help out. I'm based in Washington State, but especially the insurance industry, you can get licensed in other states if you have questions on these things. If you want to email us or contact us, at a minimum, we're happy to give you these videos and spread knowledge out there, and just kind of create more knowledge and education in the retirement services industry, especially about a complicated topic of annuities. Our next videos, we're actually going to dive into each of these products more in detail. This is kind of the overview, and we'll kind of go, here's the benefits, here's the negatives, and just kind of give a more well-rounded per product video, but that's going to take some time. So thank you, and I hope you have a good rest of your day.